And John, the great IPO sale is about to begin. Whether it's a fire sale or not, that's the big question. More than 220 companies are seeking to go public in 2019. Wow, half of that are unicorns with values over $1 billion. The market capitalization of all these companies together exceeds $700 billion, according to Renaissance Capital. But the float, the amount they're actually selling to the public, will likely exceed $100 billion. That will break any record we have ever seen in terms of dollar volume in a single year. Bigger than even 1999 and 2000. That was the years that represented the height of the dot-com IPO boom. Big names include Uber, WeWork, Palantir, Airbnb, and Lyft. Lyft, by the way, a very good example of trying to get more. The last round of funding valued the company at $15 billion, but Reuters reported they would seek to up that. They'd seek a market cap of over $20 billion. We'll see if they get that. Who's going to buy all this stuff at these high prices? That's the issue here. Look, there's three choices for these companies. One is stay private. Two is to go public. Or three, it's to merge. In fact, merger was the most popular exit strategy in a recent BDO survey of investment banking executives for these potential IPO companies. This no doubt reflects the hope that merging is the best way to get the highest price. But IPO investors do seem to be very hopeful. Take a look at this IPO ETF. This is the largest 60 or so IPOs recently, up 30% this year. So guys, the setup is perfect. The IPO business is good. Lyft's setup is perfect. Tech stocks have been big leaders. The market's holding up really well. We'll see if it continues that way. But Lyft's market timing for Lyft, just about perfect.
Wow. Well, let's bring in Steve. Steve, interested in your take. Given all the money going into startups these days from the likes of SoftBank, driving up valuations, and then this huge float that we expect to see in 2019, what are the upsides? What are the dangers?
Yeah, so I think this is going to be a really interesting year. I mean, if 2018, which was a good year for IPOs, if we look back on that, I think that's going to look like the appetizer compared to 2019. If you just look at, you mentioned 220, Bob, IPOs queued up for this year. If you just look at the top 7, they represent over $180 billion worth of private market capitalization today. So those are, that's Uber, Lyft, Airbnb, Slack, Pinterest, Stripe, and a couple of others, Palantir as well. So just those 7 are going to be sort of this monster occasion. And if you look at Lyft, I would assert Lyft is really, the soup or the salad of this. It's going to be among the smaller ones of what's going on this year. I think on the positive side, these companies are still growing. What was, I think, encouraging about Lyft's S1 filing from last week is, they doubled revenue. Unfortunately, I think the losses are gaining, but the unit economics look better than I think many folks predicted. So the take rates are higher than I think expected. And I think as we begin to see more and more of these other companies sharing more details, not just sort of the high-level metrics as Uber's been doing for a couple of years, I think we're going to see some interesting things under the covers. Certainly Uber, right. I'm excited for. Stripe, I think, is going to be a monster. Airbnb as well. So I think on the positive side, these companies represent a lot of value, and I think are going to be, in many cases, enduring brands. On the risky side, I think we've seen some companies get jammed out. There are plenty of examples. And I think the question for some of these is, will they be more like Spotify was a year ago, or Snap from a couple of years ago? So the unit economics and profitability questions, I think, are the ones that are going to dominate for some of these that are on the bubble.
Okay, so Bob, for investors who are looking at these IPOs, where are the riptides when there's this much?
The riptide's very simple. These guys these are not startups. None of these companies. We had 10, 11 years where they had enormous amounts of private funding at very cheap capital. That's one of the reasons, capital costs. That's one of the reasons they're private. And what I regret about this whole process is we've essentially taken out the early growth premium from these companies. Traditionally, they would have gone public a lot earlier. Now you can say, okay, Bob, they would have gone earlier, maybe not ready, and now they're more mature, and now they have a better idea of where they're going and what they're doing. Well, I'm sorry, I'd rather see a little bit of volatility, investors play around and get the early growth spurts than see what we've got now. Now they're much more mature companies. Many of them still don't make money. We'll see if there's enough appetite out there for these kinds of companies that are in the middle of their economic life cycle. That's the way I look at it.
We talked about this a few weeks ago, and you said you would rather have
the dot-com
boom and the dot-com bust.
And you raised your eyebrow. And you raise your eyes. It really Ideally, you'd like to see that. Well, yeah, there were some real winners and losers, and we tend to remember some of the losers, but look what came out of that. You know, Google came out of that. There were some real big ones.
Amazon IPO.
Yeah, they all did well. So yes, if I would rather take that volatility and try to pick out the winners and losers than have companies that have been already sitting out there for many, many, many years.
Yeah, Steve, just to that point, I mean, when you look some of these valuations in the private market, Uber, 120 billion, are you invested in that? Palantir, 41 billion, Airbnb, 31 billion, and just go down the list. Are those valuations going to stand up once these companies become public?
I'd say half of those companies are going to look like you know, the Spotifys or the Facebooks when you look sort of 2 or 3 years out. There's going to be a lot of near-term volatility, no doubt about that, and everyone's going to be watching, you know, 6 months and a day afterwards when the lockups come off these, who's selling. But I would say there are going to be absolutely some companies that have long-term value. So you're absolutely right, Bob. If you kind of look back 20 years, the companies that were going public, Amazon went public when it was 3 years old at a $440 million market cap. That's all of that accretion, of course, has happened in the public markets almost to the factor of 2,000x. Facebook, you know, whatever, 15 years later, went public at $106 billion market cap, and it's up 5x from there, which is encouraging. But we're not going to see, for sure, as much value unlocked in these public markets. There's just not nearly as much room to run. But I do think we're going to see 3-4xers over the next 3 to 4 years for the good companies, and they're going to have to prove themselves, certainly with good unit economics and profitability in the medium term. But again, these aren't sort of small brands. These are massive markets. We're talking about transportation and food and hotels. So I do think that the companies that figure this stuff out are going to be enduring brands with 5 to 10x potential over the next 3 to 5 years.